Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
In today's episode, you'll learn about, first, heading into today's open. A market narrative shattered overnight. Strong GDP data triggers a violent rotation from tech to industrials. Watch for the Nasdaq to face a reckoning at the bell as the Dow soars. Second, Nvidia's rally masks a hidden truth. The AI picks and shovels trade ignites, with some stocks skyrocketing over 300%. While everyone watches the giant, a shadow rally in AI infrastructure is creating a new class of winners. But with a capex cliff looming, is this a historic boom or a bubble about to burst at the open? Finally, crisis looms for Amazon. A $1 trillion AI agent revolution triggers a shadow war, threatening its entire business model. This isn't just about losing sales, it's a direct assault on Amazon's $60 billion advertising profit engine. As the AI data scraping war explodes, will the market begin pricing in this existential threat today? The narrative just flipped. For months, the market bet everything on aggressive rate cuts, driving growth stocks to the moon. But that story just hit a brick wall. The data is too strong, the Fed is too patient, and the easy money trade is officially over. While the Dow Jones pushed to new all-time highs, gaining nearly 300 points, the Nasdaq barely budged. Don't let the green arrows fool you under the surface. We are witnessing a massive capital rotation. The S&P 500 managed a modest gain, but the divergence tells the real story. Investors are beginning to dump high-flying tech exposure in favor of industrial safety and financial sector yields. Why is the delayed third quarter GDP report causing such a stir? Because the numbers are simply too good. The US economy grew at an annualized 4.3%, shattering the consensus estimate of 3.2%. This is a game changer. It effectively kills the recession is imminent, so the Fed must save us argument. With growth, this robust Federal Reserve Chair, Jerome Powell, has explicitly shifted to a wait-and-see stance, stating that rates are within a neutral range. The futures market reacted instantly. The probability of a January rate cut collapsed from nearly 20% to just 13% overnight. From a valuation perspective, this forces a total repricing of risk. The 10-year Treasury yield ticked up to 4.16% following the data release. In this environment, the discount rate for future earnings just went up. A technology company trading at 50 times earnings with zero current profit suddenly looks incredibly expensive compared to a risk-free bond yielding over 4%. This is why we are seeing the momentum drain out of the Nasdaq. The market is waking up to the reality that rate cuts are off the table for at least 6 months and inflation remains somewhat elevated. However, this macroeconomic backdrop is creating a perfect storm for the financial sector. Stocks like Prudential Financial rebounded sharply after a week of selling, buoyed by a $1 billion buyback plan. Investors are realizing that a higher for longer rate environment is a massive tailwind for banks and insurers, allowing them to expand net interest margins, the difference between what they pay on deposits and what they earn on loans. If the yield curve remains elevated, capital flows will likely continue shifting from the tech-heavy Nasdaq into the financial-heavy Dow. That said, not all technology is being sold off indiscriminately. It is becoming a stock picker's market focused on tangible earnings. Micron Technology, a leader in the semiconductor memory space, surged nearly 4% to new highs. This move is driven by the specific supply shortage in high bandwidth memory required for AI infrastructure. The market is clearly distinguishing between companies that provide the picks and shovels for AI and are generating massive cash flows right now versus speculative software companies promising growth 3 years down the road. We also saw a significant insider signal in the consumer discretionary sector. Nike jumped 4.6% after filings revealed that Apple CEO Tim Cook personally bought 50,000 shares. When one of the world's most sophisticated executives buys the dip in a beaten down brand, the market interprets this as a major vote of confidence in valuation, suggesting that even in a shifting economy, strong brands at the right price still command attention. Perhaps the most telling signal, however, isn't in equities at all. Gold is trading near all-time highs around $4,500 an ounce. Typically, strong economic growth and higher bond yields act as kryptonite for gold. The fact that precious metals are rallying alongside the dollar suggests that smart money is hedging against a potential policy error or a resurgence in inflation later in 2026. The VIX volatility index is sitting near 13.5, a level that historically screams complacency. Markets rarely stay this calm when the fundamental narrative is shifting this violently. The impending employment data in January will be the final verdict on whether this no landing scenario holds. The rotation has begun. The question is whether portfolios are positioned for a world where earnings growth matters more than Federal Reserve support. Heading into today's open, the biggest story in AI isn't just Nvidia. We've been tracking how the AI build-out's choke points were shifting beyond the headline chip designer, and now the suppliers behind connectivity, memory, and storage are taking center stage. While Nvidia's historic rally grabs the headlines, a handful of under-the-radar companies supplying the guts of the AI revolution have delivered even more explosive returns. This is the picks and shovels trade of the AI gold rush. With big tech projecting a collective spend of $380 billion on data centers, the companies providing essential hardware are seeing unprecedented demand. As we flagged, this concentrated spending can crowd out capital from other sectors, creating an economy of AI haves and have-nots. Now, get this. The sheer scale of this buying is creating its own economic ripple effects. This demand from just a handful of tech giants is causing shortages and price hikes for specialized components. The producer price index for semiconductors, for example, is climbing faster than broader inflation. We previously said this PPI would be the tell for whether tech-driven inflation becomes sticky. The fact that it's now running hot could create a stubborn pocket of industrial inflation, complicating the Fed's last-mile fight to get inflation under control. Look at Lumentum, ticker LITE, which makes optical components. The stock has skyrocketed 372% this year. Western Digital, WDC, a 55-year-old hard drive maker, has surged nearly 300%. And it's not just them. Celestica, Micron, and Seagate have all posted triple-digit gains. Speaking of which, Celestica's story reveals a deeper trend. The company supports the creation of custom-designed chips, or ASICs, for giants like Google. This signals a structural shift where big tech is designing its own specialized, efficient chips to move away from relying solely on Nvidia. It's a long-term trend that could eventually challenge Nvidia's pricing power. What really brought this to a head was the next development with memory. After memory maker Micron, ticker MU, blew away recent estimates, Morgan Stanley analysts called its results the best revenue and profit upside in the history of the US. Semis industry aside from Nvidia. So the thing is, the reason Micron is so overwhelmed with demand is that we are in the most intense compute-heavy phase of the AI revolution, training the models. This requires massive amounts of a special component called high bandwidth memory, or HBM. Micron's own business chief confirmed the company is more than sold out, even shuttering consumer lines to save supply for AI customers. This also highlights a major geopolitical risk. The world's supply of HBM is a critical choke point, much like oil was for the 20th century economy. The US is heavily reliant on Asian allies for this, with Micron being the only major domestic producer. This strategic vulnerability is exactly why you see government initiatives like the CHIPS Act granting billions to Micron to reshore this vital part of the supply chain. For our audience in the Chinese-speaking world, this also widens the high-end technology gap for domestic chip makers, increasing the odds of future gluts in legacy chips while the premium HBM market remains out of reach. This all sets up a critical dynamic. This decision to pour money into infrastructure brings both an incredible boom and comes with inherent risks. Research from firms like CreditSights points to a potential capex cliff. The current spending spree from big tech is front-loaded a massive amount of money right now to build initial infrastructure, but forecasts are starting to show a potential slowdown in revenue growth for these suppliers around 2027 or 2028. If that happens, it could signal the end of this investment boom, and these stocks, priced for perpetual growth, could face a sharp correction. The key thing to watch at the open is whether traders continue to pour money into these high-flying names or if the lofty valuations trigger profit-taking. Keep an eye on that semiconductors PPI print. It could be the tell for whether this tech-driven inflation persists. We've been talking about the hardware gold rush fueling the AI boom, but the software layer is where the next corporate war is brewing, and it's aimed directly at Amazon. A new report is spotlighting a $1 trillion threat from what's being called agentic commerce. That's the potential size of the market for AI shopping assistants by 2030, according to McKinsey. This new wave of AI from OpenAI, Google, and Microsoft could soon control how you buy everything online. Instead of going to Amazon.com, you might just tell a chatbot what you want, and it finds the best deal anywhere on the web, cutting Amazon right out of the picture. But that's not the whole picture. The real danger isn't just about losing the sale itself, it's a direct assault on Amazon's hidden profit engine, advertising. Amazon's ad revenue is a massive business, projected to exceed $60 billion in 2025. This is where sellers pay to show up first. These new AI agents, however, are designed to find the best product, not the sponsored product. This could disintermediate Amazon's high-margin ad network, shifting billions away from retailers and toward AI providers like Google. When we place Amazon's current ad-based model alongside the goal of these new AI agents, the contradiction becomes clear. One analyst warns that retailers risk paying a toll on someone else's highway for the same transaction. You see, this is a structural threat to e-commerce profit margins, very similar to what happened with online travel agencies like Booking.com, which inserted themselves between customers and hotels, taking a significant cut. If Amazon has to pay a toll to AI agents, its profitability could be permanently damaged. And the shift is already happening, with a Morgan Stanley report noting nearly a quarter of Americans have already made a purchase using AI in the past month. Amazon, of course, is not taking this lightly. Ahead of the bell, it has gone on the defensive, updating its website to block 47 different AI bots from its rivals, walling off its valuable product and review data. The conflict has even spilled into the courtroom, with Amazon suing AI startup Perplexity for scraping its site a move. Perplexity fired back against, calling it a bully tactic. And believe it or not, this is not an isolated incident. It's a key battle in the widening AI data scraping war. Content providers everywhere are putting up data walls to protect their proprietary information, which is the lifeblood for training AI models. This trend could hinder the development of these powerful shopping agents, but it also entrenches the power of incumbents who control the data. However, if you zoom out, you'll see another layer of strategy at play. Amazon is playing both sides. The company is actively looking to partner with some AI agents while simultaneously pouring money into its own competing tools, like the AI shopping assistant Rufus. Interestingly enough, this frenemy strategy mirrors the ecosystem competition in China's e-commerce market. There, super apps like Douyin, the Chinese version of TikTok, disrupted monolithic platforms by integrating shopping directly into video content, creating a much more fragmented market. This history suggests the US market could be heading in a similar direction. This sets up a critical test for Amazon at the market open. The company's massive market share means it has the most to lose. Watch shares of Amazon, ticker AMZN, along with competitors like Google and Shopify, ticker SHOP. At the open, look for how the market prices this triple threat to Amazon, the risk to sales, the erosion of ad revenue, and the battle for data control.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.